Silver prices have been absolutely hammered today. There's no other way to put it. We are witnessing one of the sharpest and most aggressive drops in silver prices in recent memory, and understandably, a lot of people are confused, frustrated, and even panicking. The big question right now is simple. Is this the end of the silver rally, or is something much bigger happening beneath the surface? Let's walk through exactly what's going on, step by step. As of today, silver is trading around $72 to $73 per ounce, depending on where you're looking. That represents a drop of roughly $7 on the day, or close to 9%. The volatility has been extreme. Prices didn't just drift lower, they fell sharply, bounced briefly, then continued to slide. Just last night, silver climbed as high as $83 per ounce. During that session, prices then dropped quickly to around $75, recovered slightly when Asian markets opened, and from that point onward, selling pressure remained relentless. At its lowest point, silver touched roughly $71 per ounce, marking one of the largest short-term declines we've seen in years. This kind of move gets attention, and for good reason. It's also important to understand that silver wasn't alone today. Gold moved lower as well, currently trading near $4,356, down about $182, or roughly 4%. Platinum saw an even more dramatic sell-off, dropping more than 13% in a single session. So this wasn't a silver-specific event. We saw weakness across the entire precious metals complex. However, when we look a little deeper, the story becomes more nuanced. The gold-to-silver ratio moved higher today, not because gold surged, but because silver fell much faster. Even so, the ratio remains below 60, which historically suggests that gold is still relatively strong compared to silver. That tells us this move looks more like a violent short-term dislocation rather than a complete breakdown of the long-term trend. Now, here's where things start to get unusual. We are seeing backwardation in the silver market. In simple terms, this means that spot silver is trading higher than futures contracts. Spot prices are around $72.40, while futures are closer to $71.50. That is not normal behavior for a well-supplied, stable market. Backwardation usually signals stress in physical supply and immediate demand for real metal, not a lack of interest. And when we compare prices in Western markets to what's happening in Shanghai, the disconnect becomes impossible to ignore. Silver in China is still trading at a significant premium compared to prices in the US and London, roughly $10 higher per ounce. Same metal, same moment in time, completely different pricing. That price gap didn't close during the crash, it actually widened. So what's driving all of this? The main catalyst is the COMEX margin increase that went into effect today. This was announced last Friday, and historically, margin hikes almost always lead to sharp price declines, especially in highly leveraged markets like silver. Here's how it played out this time. Gold margins were increased by 10%, silver margins were increased by 13.6%, platinum margins were increased by a massive 23%. The outcome was predictable. The metal with the highest margin hike, platinum, experienced the largest decline, silver followed, and gold declined the least. This is exactly what you would expect when leveraged positions are suddenly forced to meet higher capital requirements. We've seen this movie before. Back in December, COMEX raised silver margins by 10%. Silver dropped sharply that day, only to recover the very next session. This time, however, the scale of the move was much more severe. At one point, silver was down nearly 14% in just a few hours, wiping out an estimated $650 billion in market capitalization across related assets. Another telling data point came from prediction markets. The odds of silver reaching $100 per ounce in January collapsed from over 50% to roughly 16% within hours. While prediction markets aren't perfect, they do reflect a sudden and dramatic shift in short-term sentiment. But here's the most important part, and this is what most people are missing. This does not look like a true market sell-off driven by collapsing demand. It looks like a forced liquidation in the paper market. While traders in the West were watching silver crash on their screens, buyers in Shanghai were still bidding aggressively at much higher prices. That tells us something critical. Paper contracts are being dumped, but physical demand remains strong. COMEX has raised margins twice in just over 2 weeks, and it did so during a period of low holiday liquidity, when moving capital is more difficult. That timing matters. It puts maximum pressure on leveraged longs and forces liquidations regardless of fundamentals. Paper contracts settle in cash. Industrial users, manufacturers, and nations settle in metal. And that distinction becomes even more important when you consider that export controls on silver are expected to go live very soon. Once those controls take effect, arbitrage opportunities between East and West could disappear almost overnight. Meanwhile, the physical market is telling a completely different story. Major US bullion dealers are now reporting 3 to 4 week delays on many silver products. Wholesale inventories that appeared plentiful just days ago have rapidly evaporated. Even as paper prices collapse, physical silver is becoming harder to source. That's not what the end of a bull market looks like. What we're seeing instead is a classic shakeout. Volatility like this is designed to do one thing extremely well: force out weak hands. Speculators panic. Leveraged traders get liquidated. Long-term holders step in. Could silver go lower from here? Yes, it absolutely could. Is the volatility over? Probably not. But from a fundamental perspective, nothing meaningful has changed. The world is still facing a structural silver deficit, industrial demand remains strong, and physical supply appears tighter today than it was before the crash. If you've been waiting for a pullback in silver prices, this is that pullback. No one knows exactly what tomorrow or next week will bring, but one thing is clear: this move was driven by leverage, margins, and market mechanics, not by a sudden collapse in real-world demand. I'll be watching this situation closely and will keep you updated as things develop. Thanks for watching, and I'll see you in the next video.